Hello and welcome to Startup Street. I'm Arundhati Ramnan, and joining me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. SaaS-enabled marketplace Venwiz bags $8.3 million. The Series A round was led by Sorin Investments. Existing investors, Axel and Nexus Venture Partners, also participated. Funds will be used for product enhancement and team expansion.
HR tech platform HireSure AI gets $2.5 million in series funding led by Y Combinator and Bindi Balcells. 3 State Capital, Tribe Capital and Pioneer Fund also participated. Plans to use the funds to build new products and scale up the engineering and product teams.
Paytm completes buyback of shares worth a little over 849 crore rupees at an average price of close to 546 rupees apiece. According to regulatory filings, the company bought back shares in the price range of 703 to 480 rupees a share. During the buyback period, Alibaba sold its entire direct stake in the company in 2 tranches.
Grocery delivery service JioMart expresses reports JioMart is exiting the heavy burn business that it launched last year.
Elon Musk is aiming to appoint his successor as Twitter CEO by the end of this year, says he needs to stabilize the company first and ensure it is financially healthy.
Social media platform Reddit may go public in the second half of the year, say reports. Reddit is keeping its IPO paperwork up to date in preparation for its debut when market conditions improve, the report added.
Salesforce CEO Mark Benioff admits that laying off thousands of employees during a 2-hour all-hands meeting call over a call was a bad idea. He tells New York Times it's hard to have a call like that with such a large group and have it be effective, and we paid a price. Those were the headlines that we're tracking for you this evening. Now, Indian software as a service companies are poised to command 8% of the global SaaS market, generating $35 billion in annual recurring revenue by 2027, growing at 20 to 25% per annum. This, according to Bain & Company's latest report on India SaaS Report 2022. It says that almost 90% of Indian SaaS investors are expecting to either increase or maintain their capital allocation to SaaS.
The report finds that of the 1,600 Indian SaaS companies that have been funded over the past 5 years, around 14 of them exceed $100 million in ARR versus around 1 or 2 5 years ago. And they're also reaching this growth milestone as quickly as their peers or counterparts in the US. To discuss this report and its findings, joining Arundhati and me now is Aditya Shukla, who's partner at Bain & Company.
Hi, Arundhati here. Thanks for joining in. Now, the report finds that the Indian SaaS companies will generate $35 billion to annual recurring revenue by 2027 and command 8% of the global market in 5 years. So what is going to drive this kind of growth?
So, Arundhati, a bunch of things, right? I think one, SaaS has a lot of white space globally. So even if you look at the developed markets and you look at some sub-segments that are very well developed, there's still a lot of headroom for growth. 2, Indian SaaS companies have actually demonstrated clear pockets of strength and leadership. So whether it is product quality, whether it is high service excellence, whether it is competitive pricing in many cases, you have a situation where Indian SaaS companies are actually becoming leaders in their categories. And in some cases, they have actually helped create the category itself, right? So if you look at a bunch of DevOps or testing-focused companies, they are market leaders, they are category creators. And then lastly, the last 4 or 5 years, the way this ecosystem has evolved, you have, as you mentioned, $12 to $13 billion of revenue generated by Indian SaaS companies. This is up 3x versus 2019. If I look at the investments that have been made into SaaS, that number for last year was around $5 billion. That itself is significantly up versus what you had previously. So the entire flywheel from both a company lens as well as from an investor lens seems to be turning quite well. And that's why we feel fairly confident that given the growth trajectory of individual companies and given the interest that investors have in SaaS, you will see more and more winners really break out from India SaaS. And when that happens, we will just capture a much larger part of the global pie.
Aditya, since you brought up the investors and that they'd invested about $5 billion in SaaS companies last year, your report also finds that 90% of the investors are now actually expecting to either increase or maintain their capital allocation to these companies. So, what kind of returns should we expect, or are they expecting? And what are the specific subsectors that actually look more promising versus the rest?
So, look, I think returns obviously will vary depending on the different subsectors, which I will get to. I think the reason investors find it exciting is, one, because most SaaS companies have very strong unit economics. So you're talking about gross margins of 75-80% plus, in some cases even higher. So fundamentally, the business model is very well proven for these SaaS companies, which I think makes it super exciting for investors. Two, you're already seeing more and more exits. So I think 2022 had around 40 odd exits within the Indian SaaS ecosystem. If you look at how globally exits have trended, there's a very clear track record of IPOs, of secondary exits, of both SaaS companies as well as legacy companies buying out smaller SaaS companies. I think all of those are possibilities for SaaS investors. So they are very bullish and excited about that. From a subsector lens, look, it's spread across three broad areas. One is horizontal SaaS. So think of your classic, ERP, CRM suite, marketing tech companies. That continues to be the dominant pool of Indian SaaS. Large TAMs, very underpenetrated, not winner-take-all markets. And you've seen a bunch of Indian SaaS companies play in that. The second segment, which is very exciting for investors, are your DevOps-focused SaaS companies. So companies that are focused specifically on developers. This is where your companies like a Hasura or a Browser Stack or a Lambda Test, many of Postman, many of them will play.
Right.
That is interesting for investors because Indians have been category creators in this space. India actually houses around 10-15% of the global developer base. And the product quality is really good. So that's the second area of interest. And the third, I would say, selectively, you will see vertical SaaS companies.
Right.
So you've seen Zenoti, you've seen Innovator, you've seen a few others that are vertical focused.
Okay.
Our sense is, and speaking to all the investors, that you will have fewer vertical SaaS companies because the TAMs are smaller, but you will end up having more winners within that. So broadly, these are three areas.
Right.
And even if I look at areas where Indian SaaS companies have seen a lot of proliferation, there's still a lot of white space. Which is what's exciting for the investors because they think there's that much more headroom for
So you're saying we'll see fewer companies, but better quality companies and more winners. So it was another record year for Indian SaaS investments in 2022. Despite a funding winter, PE and VC investment reached $5.1 billion, which was up 20% versus 2021. So do you expect this momentum to continue? Will we see more early stage funding at this point?
Great question. So I think early stage funding actually for SaaS exponentially increased also 2022. So that will continue growing. What happened over 2022 is the first half of the year saw secular growth in investments across all company cycles, across all deal cycles. The second half actually saw a dip when it came to large deals and mega ticket size investments. And I think the reason for that was that there has been some valuation pressure given what's happened in the US market.
Aditya, we seem to have you on a bad line, so we can't hear you very clearly, but we're also completely out of time. Thank you so much for joining us on the show today. Moving on, EdTech startup College Deco recently bagged $9 million from Winter Capital, which doubled down on its investment on the firm. The startup had earlier raised $35 million in a Series B round last year, which was also led by Winter Capital, along with ETS Strategic Capital and other investors. Started in 2015, the platform now connects prospective students with colleges using its proprietary technology and an AI-based chatbot, and has since then counseled over 70 lakh students and around 1,500 colleges with their student recruitments. Joining us now to discuss the company's growth plan is Ruchir Arora, the co-founder and CEO of College Deco. Ruchir, thank you so much for joining us on the show today. You're a college admissions and higher education services ecosystem. Talk to us about the various services that you have on offer. Any new offerings in the pipeline?
Thanks for having me. Yeah, we started with helping students get the right college and the course, and we are sort of sticking to that.
Right.
That's sort of been our most high growth business, and as you rightly said, upwards of 70 lakh students have actually been counseled by us. We've also sort of understood that this category is essentially in two phases, right? We work for kids who are going to these private colleges, people who are not amongst the top 5 percentile of their college search or of the school. So helping students find the right college, and then while they are studying in college, we are actually one of the first ones who's helping kids gain knowledge in terms of their curriculum courses, and also we are helping them get skilling courses while they're studying in college,
Right.
so that when they come out as better experienced professionals. Given the fact we keep hearing a lot about unemployability and kids coming out of colleges not being employable now. So we are essentially now started working on that for the last year.
All right, so that's what you've also been working on. You recently raised $9 million from Winter Capital in an ongoing round. How do you plan to use these funds? What's on top of your agenda?
We've been, this is the third or fourth interaction that I'm doing with you guys, but
Right.
we've always been, almost an 80% gross margin company. On and off, we are EBITDA positive, and we choose to invest back in the business. So, this quarter itself, in the Jan-Feb-March quarter, we are again EBITDA and cash positive. So we are essentially on good territory when it comes to, business. All this money is sort of planned to use towards growth, and moving from the revenue that we were doing last year to triple down or double down on that revenue.
All right. In fact, I was going to ask you more about your revenues itself. You reached 100 crore rupees in FY 21-22. What do you plan to clock for this current financial year? On track to turn EBITDA positive at this point. So what's the road to profitability looking like?
So, we were very close to 100 crores last year. We have actually grown 2x from there. So we should be very close to 200 crores this year.
Okay.
And as I said, we choose to sort of invest back in the business. But if you look at our Jan-Feb-March quarter, which is the Q1 for the calendar year, we are already turned EBITDA profitable. And we see the similar kind of growth growing on next year as well, and our projections say that we'll keep maintaining this EBITDA positive territory, and next year again we plan to grow more than 100% and with healthy 15 to 20% EBITDA.
All right. Talk to us about the traction you're seeing for your offerings. Where are you seeing the most amount of growth? How many students have you worked with, and how do you plan to grow this further? How do you plan to grow your base?
So we own two large college search properties. One is collegereco.com, and the other one is what we acquired last year called Get My Uni.
Right.
Between both of us, we essentially clock almost 10 to 15 million sort of visits a month, which gives us access to almost 40% of all college-going students in an year. And that sort of helps us then channelize them to find the right course college. And then, as I said, the new service offering that we've had is very interesting, where we are essentially working with colleges to give skilling courses as well as placement guarantee courses to students. So, it'll be one of the first few, sort of integrations when you work with colleges, not only give them enrollments in terms of the best student that they can join the college, but also help them find the right skill and eventually the right job as they graduate from college. So that's what sort of we've been working a lot on, and that's where we see the next phase of growth coming from.
All right, so that's where your next phase of growth is going to come from. Are you looking at more inorganic opportunities? Are you in talks with any companies? What's the plan on that front?
Yeah, so frankly, we are always looking out to find companies which can help complement our skill set, or companies which can help sort of grow us. But as of now, we've sort of done 2 acquisitions in the last 12 months. So we are sort of right now being more we are working more on consolidating them and trying to create the right value out of some of these companies. So in near term, you won't see anything, but yeah, always in lookout to find the right set of companies which can complement our skill set.
Right, so always on the lookout, but currently just working on the acquisitions you've already made. But India's edtech sector has seen a whole host of layoffs and has essentially seen a shakeout. So what's your hiring plan, and what are the conversations you've had with your investors considering the current scenario?
Well, I think I would say that, some of these, especially, in the edtech, there was a big boom around the COVID times because a lot of this education moved online. We, neither get affected negatively nor very positively on COVID time. So for us, we've been sort of running a very steady business over a period of time, growing by 80 to 100% year on year. So we didn't see a lot of shakeout. In fact, we've grown from almost 700 people about a year back to about 2,000 people today.
Right.
So we almost doubled down, and we keep hiring, and we sort of are looking to hire another 500 to 600 people in the next 3 to 4 months. On investor conversations, I think there's a lot of focus on path to profitability, which you sort of picked up earlier.
Right.
And also, reducing cash burns and definitely more sort of aspiration to see how some of these, obviously the valuations have, definitely not compromised, but definitely rationalized a bit from what it was
Right.
about a year back. But again, we are sort of thankfully better positioned at some of these things because we are EBITDA positive,
Absolutely.
growing, and sort of we're sort of being able to maintain good relationships with all our
Right. So
existing and investors.
absolutely. So you've seen steady growth and you only keep growing. All right, Ruchi, thank you so much for joining us on the show today, and we wish you all the best going forward.
Thanks for having us. Thank you.
Now, digital lending platform mPocket is looking to expand its workforce by March next year across verticals to maintain its growth trajectory. The total number of employees currently at the Kolkata-based company stands at around 2,700, which includes its employees from the Bangalore office as well. Joining me now to talk about these expansion plans and the impact of recent RBI digital lending guidelines and more is its founder and CEO, Gaurav Jalan. Gaurav, thank you very much for being with us here on Startup Street and welcome to the show. Let me start by asking you about your expansion plans. You have 2,700 employees currently. How much are you looking to increase that by? And it's coming at an interesting time because most of the startups are looking at tightening their purse strings. Some are even cutting back on jobs. What gives you this confidence?
Hi, Ritu. Thank you for having me. So you're correct that the environment has been difficult for startups. A lot of them are laying off people. Thankfully, we are in an area of business where the industry has been growing very rapidly. So demand for credit, especially among the youth and the underserved in the country, is very high. This is an unserved market, and we have been able to solve this problem by finding a way to underwrite these customers and provide credit to them cost effectively. So that's been allowing us to grow our business pretty handsomely over the years. I mean, generally, we've been growing our business about 2 to 3 times annually. And along with the growth in our business, we've also had to grow our workforce, obviously, because we need people to serve our customers. So roughly, I think in line, again, for the coming year, we expect our business in volume terms to grow about 2 to 3 times, and we'd expect our workforce to maybe grow about 2 times in the coming year from the current base of 2,700.
All right, so almost doubling your workforce from 2,700 currently. What kind of revenue profitability are you currently, what is the run rate currently, and what kind of growth are you expecting there?
So Ritu, last year in calendar year 22, we disbursed or facilitated loans worth about 3,500 crore. And we expect that to grow 2 to 3 times in this calendar year. And as far as profitability goes, we've been running our business pretty efficiently, had a very strong focus on profits right from the beginning. So we've been a profitable company now for the past few years, actually.
Okay, you've been a profitable company. We haven't heard the profit figure yet, but irrespective, let me also ask you about another issue that has really plagued the fintech lending community. It's been a past, tough couple of weeks with the mighty ban on, the Ministry of Electronics ban on loan apps and websites. While mPocket, of course, clarified it was not part of that list, there was a company with a similar name that was banned. Has that issue been resolved now? Have you identified who it was?
Yes, Ritu, that issue has been resolved. So this was an industry-wide kind of clampdown by the government because, they saw it as a national security issue where there were a lot of players who had origins from different countries who were collecting data on Indian consumers, also, kind of offering loans at usurious terms and harassing people for collection. So this was a menace actually for the entire industry. So this is a very good move by the government. I mean, the RBI has already, set out the digital lending guidelines and done a lot of clarifications, but the RBI only controls regulated entities. The problem is that there were a lot of companies that were operating outside this regulatory ambit of RBI, and they were essentially posing a threat to the country. So I think that's where the government came from. And I think this was a very good move where they identified a lot of these companies and effectively they've banned them. And I think legitimate companies like ours, we were invited by the government to effectively, provide information and documents that prove our legitimacy. And, once we communicated that to the government, it was very clear that we were not under the regulatory glare. And it was more directed towards these these other companies that were doing business in a bad manner. And regarding that particular app that was kind of impersonating us, I mean, this is again, it's a problem that is there across the industry. I mean, we deal with it on a case-to-case basis, but unfortunately in the digital space, it's very easy for people to impersonate and do fraud. So whenever we find out about these instances, we obviously take proactive moves as well. We try and get these apps removed.
Well, Gaurav, another issue I quickly wanted to touch upon before we let you go is the recent FAQs now, the clarification that RBI has released on these digital lending guidelines. The big change, of course, is that it has now allowed payment aggregators who also work as lending service providers to be used for loan repayments, which earlier wasn't the case. Does it make life a lot easier for the industry, or anything the community would still need more clarity on from RBI on these guidelines?
So I think these FAQs are a follow-up to the digital lending guidelines that came out in September from the RBI, and they have some clarifications that the industry had asked for. So I think the RBI has clarified that payment aggregators can also act as LSPs, but if they act as LSPs, actually they will have to adhere to the guidelines that are there for LSPs. So it kind of limits the range of functions that they can perform. Overall, I think these FAQs are a step in the right direction. Again, certainty is very good for the industry, because eventually, businesses know what the guardrails are and how they need to perform services. Regulations are good for the customer, and what's good for the customer is eventually good for the industry. So all of these are steps in the right direction. And I think one other thing that the industry is waiting for clarification on, that we do expect from the RBI in the coming months, is a clarification on the first loss default guarantee. So that is something that did come up in the guidelines, and I think as an industry, we've sought some more clarification around those rules.
All right, so FLDG remains a gray area where you require clarity. Gaurav, thank you very much for joining us here on the show to talk about your company on some of these industry-relevant issues that are very pertinent as of now for the fintech community. Thank you very much. On that note, we'll wrap up this edition of Startup Street. Thanks for watching. Let's stay with us. The news continues on the other side.